In the year 2004, Apple stock was worth $1 and now it is worth $320. That is, if you bought them for $100 at $1, you would now have $22,000. Not bad, right? But how to choose stocks? Where and how to buy them? In this video, I'll tell you in detail what stocks are and how to make money from them. Give it a like and subscribe. And here we go! A stock is a valuable paper that confirms the right to a share in a joint stock company. More simply said, a stock is a part of a company. By buying a stock, an investor becomes a co-owner of the company, which entitles him or her to a share of its profits and the opportunity to participate in stockholder meetings. For example, even the owner of one stock has the right to participate in meetings where business development and profit distribution issues are discussed. Investors buy stocks in order to earn on their growth or receive dividends. Let's understand what this means. When a company needs funds for development, it can take a bank credit or release stocks. The larger the borrowed amount, the higher the interest payments on the credit will be. Therefore, a company may prefer to issue stock. Going public is called IPO, which is short of Initial Public Offering, which is the first public sale of a company's stock to a wide range of investors. Anyone, be it a private investor or an investment fund, can purchase these securities. During an IPO, the price of the stock is determined by calculating the authorized capital of the company, which includes equipment, storage facilities, offices, raw materials, money and other assets. The value of all assets is divided by the number of shares issued. The price of the stock will then change depending on the interest of investors. If investors believe in the successful future of the company, the demand for its stock grows, and with it, the price of the stock. If there is no trust, the price falls. That is why stocks are considered a risky investment. You can make guesses and forecasts, but it is impossible to exactly predict the company's growth. Various factors can affect the value of a stock. News in the media, new laws, competitors entering or leaving the market, investor expectations, company reports, the political situation, and even rumors. If you own stock, some companies may pay you dividends. Dividends are a portion of the profits that a company distributes to its shareholders. With the dividends, the company rewards shareholders and keeps their stock interested. The decision to pay dividends is made at stockholders' meeting. Each company has its own dividend amount and timing, which can vary. For example, it can be 10% per year, paid once a quarter, or 12% per year, paid twice a year. It is common to set the payment percentage per stock, rather than a fixed amount. Companies are not required to pay dividends. There are companies that do not pay dividends at all, investing all profits in development. It is very important to choose the right stock. After all, you don't want to sit around for a few years at a loss, do you? Here are 3 tips for choosing good stocks. First, choose the right type of stock. Some companies issue 2 types of stock: common stock and preferred stock. Holders of ordinary shares have voting rights, but they only receive dividends when decided by a general stockholders meeting. Holders of preferred stock have no voting rights, but almost always receive dividends. Preferred stocks give a stable income, but if you want to make money on changes in price of stocks, it is better to choose common stocks. Second, look into the company's business. To understand a company's business, you must first analyze its financial reports and news about it. Corporate news will help you understand what's going on in the company right now, such as whether the company is introducing new technology or has competitive advantage. Financial reports will show you how the company is doing. Pay attention to figures such as revenue, profit, expenses, and cash flow. Not only are the numbers themselves important, but also their changes. If the stock price is constantly changing, it is risky to invest in it. If the stock price increasing regularly, that's a good sign. It all seems complicated now, but believe me, when you figure it out once, you will thank yourself. Third, diversify your investment portfolio. To create a reliable portfolio, include different types of stocks from different sectors and countries. Good diversification will help reduce the risk of loss if one industry or company runs into trouble. Portfolio structure depends on your capital strategy and stock price. When choosing industries, keep in mind that in periods of economic growth, IT companies perform well. In recession, producers of essential goods, and during inflation, energy and commodity companies. Well, now for the most interesting part, How to buy stocks. Step 1. Open a stocks account. To buy stocks, you need a broker, an intermediary between the seller and the buyer on the stock exchange. He makes deals and represents the investor's interest on the stock exchange. With his help, you will open an account in stocks, so that you can then be able to store, buy or sell stocks. But about everything one by one. When you want to receive your salary on your card or deposit money in the bank, you open a bank account where the money will be kept. It's the same with the stocks. After you buy them, you need to store them somewhere. There is a stock account for this purpose. It is not difficult at all to open one. Just go to the website of the chosen broker, register there and follow the instructions. How to choose broker. The functions of a broker do not necessarily have to be performed by a live person. Investors, even large ones, often use brokers' online platforms, through which stock purchase transactions are made automatically with a single click. It is important that the company providing such a platform has a license from the regulator of particular country. You can check this on the regulator's website, such as the SCE for the US. The next important condition is the public status of the brokerage company. Public companies are required to regularly publish reports that meet international standards, and their stocks are traded on stock exchanges. Reports are checked by independent auditors, which reduces the risks of errors and fraud, thus minimizing losses for the investor. For example, Interactive Brokers is an American company and one of the world's largest brokers. Its activities are regulated by US laws, some of the strictest in the world when it comes to the stock market. The company has an authorized capital of $8.5 billion and a market value of over $27 billion. This creates for investors a strong protection for their investment. Freedom Finance is an international investment company. This company provides an opportunity to invest in stocks that are just starting to trade on the stock exchange. I mean the IPO we talked about earlier. Step 2. Replenishment of the brokerage account. To deposit in the brokerage account, you can use International Bank SWIFT transfer. This allows you to avoid restrictions on the transfers and ensure reliable and stable functioning of the financial system. In most cases, you can transfer funds from payment cards to cards of individuals abroad within the established limit. If you have the opportunity to open a card in a neighboring country and deposit cash on it, it's even easier. Some investors use cryptocurrency to transfer funds and further investments. Once you have decided on a bank, you form a SWIFT transfer invoice in your account. Most brokers have a button called Deposit or Add Money. Step 3. Withdrawal of funds and profit report. Now let's look at the types of income you can receive. There are two of them: dividends and profits from the sale of stocks. Dividends are your share in the profits of the company whose stock you invested in. They can be paid monthly, quarterly, annually or not at all. It depends on the company's policy. You make a stock profit when the price of the stock has risen and you sell it for more than you bought it for. This type of profit is called investment income. Both types of income will be displayed in your personal account with the broker. You can withdraw money to a bank card through the same menu where you formed the invoice for SWIFT transfer. From the earned money, you need to pay taxes. Investment income is not an exception. Here everything depends on the country in which you live, so be sure to study the legislation. We talk in detail about stocks and how to buy them. We have more videos about cryptocurrency, finance and earnings on our channel. Go over and take a look. I hope you found it useful. Thank you for watching. Like and write your opinion in comments. Token team was with you, and I'll see you in the next video.